Everybody, welcome to the new episode of Finance Pe Charcha. I am hoping that you've seen our past episodes. If not, y'all can go to the playlist, search for Finance Pe Charcha, and you will see our expert discussions there. While I'm sure that a lot of y'all here would have seen our past content, today's content is very different. In India, fortunately, unfortunately, it is said, believed, and I know this for a fact while we talk to clients, that 5 out of 10 people actually in India invest in some or the other way, directly, indirectly linked to either saving tax, paying less tax, or wants to avoid paying tax at all, right? And tax in that context is an extremely important decision basis which investments are made in India. And that is exactly what our topic for the day is. And the topic is everything that you need to know about taxation to do with investments. My guest today, while I have a formal introduction for him, but I'm going to introduce him in a way that I'm sure most of y'all who view this video would know and remember him for. How many of y'all here know about this product called Bharat Bond? I'm not sure if a lot of y'all here know that it's an Edelweiss product. But the man behind the product is our guest today, Niranjan Awasthi. He heads product for Edelweiss. He is the Senior Vice President. Educational background, he's a CMA, been around in the industry for the last 15 years. And I can keep talking a lot about him. But the fact of the matter is that a lot of this innovation, specifically in the fixed income space, right, that you see happening at Edelweiss is all thanks to this guest of ours. Help me welcome Niranjan. Hi, Niranjan.
Thanks, Kirtan. Glad to be here, and thank you so much for that kind introduction.
You deserve it. You deserve it.
Thank you so much.
So, Niranjan, today, like I understand, and for the viewers, what we are typically covering is most commonly traded assets or products in India that investors invest in, and the taxation that they need to know around that in this ever-changing and evolving situation. Of course, you will only be able to discuss what the nuances of tax today are, and they may change in the future if somebody else is looking at the video in the future. But as of today, whatever is available around equity, fixed income, gold, international investing, across assets and across products is what we intend to cover, correct?
Yes.
Awesome, super. So I will not take a lot of your time and people who are viewing us. Let's directly jump on to the content. I'm just going to make you the host, Niranjan, so that you will be able to make changes at your will. Niranjan, I'm only going to request you for one thing.
Yeah.
I made you the host, so now you can share the screen. Please don't mind me asking you a lot of questions.
Absolutely.
Because I just want to make sure that me personally and anybody viewing this video would understand everything that you are intending to teach us in the most simplest way. So I might ask you some questions, and I know as much as I know you, you will not get irritated with me, but
not at all. Not at all.
That'll definitely help our viewers for sure.
No question about that. Sure.
Over to you, Niranjan.
Okay, so is my screen visible? I think
absolutely.
Yes. Okay. So hi everyone, and glad to be talking about taxation, the most at least for some of people, the most important aspect when it comes to investing. As Kirtan mentioned, a lot of people invest for taxation reason, and in fact, I've seen people before asking return kitna hai, they ask tax kya hai,
tax kitna
parega. So we are really tax obsessed nation, I would say. So today what
in fact, tax obsessed was the right phrase.
Absolutely. So what we're going to do today is next 25-30 minutes try to understand how different investments in India are taxed. We have covered as many assets we can. So let's start with a disclaimer because I represent a mutual fund company. So this presentation is meant for general information and does not constitute any legal or tax advice. So it is your responsibility as an investor to take and consult your own tax consultant with respect to specific tax implications that may arise across various investments or schemes of Edelweiss mutual fund or any other mutual fund. Now let's understand, the 5 income heads.
Sure.
It all boils down to this. So there are 5 heads under which your incomes are taxed. The first is salary income. We all know our salaries, pension, etc. are taxed under that head. Income from business profession. So if you're a self-employed, freelancers, mutual fund distributors, CAs, CMAs, doctors, etc., they are taxed under this head. Then comes, income from house property. So if you're earning rent, it comes under this. Income from other sources, bank FD, interest on bank FD, interest on savings account, winnings from lottery, games, online, gambling and all comes under that. And last and most important topic for the day is income from capital gains. Is a 5th head under which your gains under mutual funds, shares, house property, gold, etc. comes under. Just a quick, recap on the income tax slabs you all would know. So there are 2 regimes now, the old one and the new one. The old one is, up to 2.5 lakhs, no tax. 2.5 to 5, 5%, 5 to 10, 20%, 10 lakhs, 30%. Why this becomes important? Because in some of the capital assets, and in fact, most of the capital asset, the short-term gains are taxed at marginal rate. The marginal rate or the tax slab rate is the rate at which your income is taxed at the highest bracket. There are certain exemptions, certain surcharge, that, above 5 crores, 37.
Sorry if I may
Yes,
interrupt.
please.
Niranjan, if let's say my income is 15 lakhs, do I
Right.
directly get taxed at 30% on 15 lakhs, or how is that taxation done?
So broadly, if you see, your salary is divided into these slabs.
Yeah.
So first 2.5 out of 15 lakh, there is no tax.
Okay.
The next 2.5 to 5 lakhs, which is 2.5 lakh will be taxed at 5%.
So
The
12 and a
next
half
5 lakhs, the next 5 lakhs will be 20%. And any income above 10 lakhs will be 30%. So in case of your, 15 lakhs, the 5 lakhs will be taxed at 30% and not the entire 15 lakhs.
Got you. So the first 2.5 is tax free. Another 2.5 lakhs, I'll pay 5%, which is 12,500.
Right.
On income between 5 to 10, I'll pay 20% tax, which is 1 lakh.
Right.
Right. And above 10 lakhs is 30%. So on my 5 lakhs, I'll pay 1.5 lakhs.
1.5 lakh.
So
Yes.
12,500 plus 1 lakh plus 1.5 lakh is a mota tax that
Mota, unless, of course, there will be some deductions and all.
Yeah.
But broadly, this is how it works.
Perfect. Got you.
Then, the tax slabs for, senior citizens are different. If you're above 80, up to 5 lakh, no tax. So these are some compensations and exemptions the government has given. Importantly, rate of surcharge. When, you are in the highest tax bracket, you earn above 50 lakh, there is a 10% surcharge. If your income, taxable total income is between 1 to 2, then 15%, and so on. It goes up to 37% if your income exceeds 5 crores. Now, surcharge is basically nothing but, whatever is your total tax on that, this surcharge is levied. So if your tax, the normal as per the slab is, say, coming to 5 lakhs and you're into 10% surcharge bracket, then 10% on that 5 lakh, 50,000 is the additional surcharge which you pay. So that's how surcharge also comes into picture if you're earning above 50 lakhs.
Got you.
Under the new regime, it's quite simple. Above 15 lakhs, it is 20% till 15 lakh. The same way the slabs are 5, 10, 15, and 20. There are no deductions under the new tax regime. They have made it very simple. Standard deduction of 50,000 against salary income for salaried people. And the surcharge rates are also slightly different. There is the highest surcharge which you pay in new tax regime is 25%. So the whole idea is government is trying to simplify tax. They are taking away legacy deductions and all, which are too complex at times. People don't use it correctly. So I think so going forward, this is the new regime which will continue. In fact, I was speaking to many youngsters within my family who have started earning. They do prefer the new tax regime because they want cash flow. They don't want to lock in insurance and ATC benefits and all. But yes, they do invest, and they should invest, but they like cash flows in their hands. And this is something which a lot of new salaried class or the Gen Z is liking it actually.
So Niranjan, in the new tax slab, what I understand from what you're saying is that if I invest in those PPFs or ELSS or insurance, or I take a mediclaim,
Right.
for which I used to get advantage in the older regime, I won't get those advantages here.
Absolutely.
But the tax rates are lower on the slabs. So like
Lower on
over
the
there,
slabs.
from between 2.5% to 5%, I think it was 10. Over here
Right.
up to 6%, the tax is only at 5%. Correct?
Absolutely.
Perfect. Okay, got you. Thank you.
So moving ahead, now coming to understanding the capital gain tax. So first, let's understand what is a capital asset. A capital asset is basically either a land or a property, shares, bonds, mutual fund units, gold, patents, trademarks. What is not a capital asset? A stock in business. So if you're having maybe gold, but you are a jeweler, it's not a capital asset because it's your stock in the business. Personal goods like furniture, your two-wheeler, your car, if you sell it, it doesn't count as a capital asset gain or a capital gain because you are using it for personal asset. Agriculture land in rural India is again an exemption. It's not a capital asset. And a bank fixed deposit, they are not capital assets. So this is not the exhaustive list, but some examples in each of the category. Now coming to what is a capital gain tax. So any profit or gain that arises from the sale of these capital asset is known as income from capital gains. Such capital gains are taxable in the year in which you are transferring the capital asset, and then it is called a capital gain tax.
Niranjan, sorry to barge in.
Yeah.
So we are saying, let's say if I'm an investor and if I've invested in gold for investment purpose and I make gains, that will be taxed under capital gains.
Yes.
But if I'm a jeweler and my business is buying and selling gold, then my profits are gained under business and profession and not capital.
Absolutely.
Correct?
Yeah.
Okay. Okay. Thank you.
What are the conditions for capital gains? There should be a capital asset. It should be transferred during the previous year. Previous year means in the year where the gains or profits happen. There should be a gain, of course, and it should not be exempted under Section 54. We'll see some exemptions as we proceed. Now coming to types of capital asset, we saw what are capital asset, what are not capital asset, but within capital asset, there are two kinds of capital asset. One is a short-term capital asset and one is a long-term capital asset. Now the crux is, within each asset class, the definition of short-term and long-term is different. Like if you can see over here, an immovable property like your house, the holding period to be defined this asset as a short-term capital asset is basically less than 24 months. If you're holding a property more than 24 months and after that you are selling or transferring, it becomes a long-term capital asset. Similarly, listed equity shares, we all know, less than 12 months becomes a short-term capital asset, more than 12 months, long-term capital asset. Unlisted equity shares, 24 months is the period to define whether it is short-term or long-term. Equity mutual funds, same as equity shares, 12 months. Most other asset class and most other capital asset like gold and some other assets, it's 36 months. So if you're holding less than 36 months, it becomes a short, more than 36 months, long-term capital asset. And why it is important, this defines the taxation on your gains. largely if it's a short taxation is on a higher side, uh, and if it's a long-term gain, the taxation is on a lower side. It is basically done to promote long-term holding of these asset classes and reduce any trading or impulsive buying selling in these asset classes. Now let's see the capital gain tax for each of the capital assets, starting with our favorite, which is domestic equity mutual funds. So first, let's understand what is a equity mutual funds. For equity oriented mutual fund to qualify, uh, more than 65% investment has to be in domestic equity shares.
Okay.
That's how it is defined under the taxation regulation. So if you sell equity oriented mutual fund before 12 months, it will attract a short-term capital gain tax. That is 15% plus surcharge is as applicable plus 4% cess. Domestic company, the taxation is same. Residence or NRI, it's the same. Long-term capital gain tax, if you hold and sell it after 12 months, 10% flat plus surcharge as applicable plus 4% cess. Same for domestic company. There is one very important point, that you have an exemption up to 1 lakh rupees of capital gains in equity mutual funds. So what essentially it means is, if your gains in any financial year are till 1 lakh, they are completely exempted from this 10%. Anything above 1 lakh will be taxed at 10%. The other thing is surcharge is capped at 15%, because there will be individuals who are in the highest surcharge bracket, like say 37%, 25%. So that is capped at 15% as far as equity mutual funds are concerned.
Sure. And over here, when we say domestic company, we are saying some Indian company who's invested in equity mutual funds.
Absolutely. Domestic company is Indian company. Yes. For domestic equity shares listed, the taxation is same like equity mutual fund. Less than 12 months, 15% plus surcharge plus cess. If it is more than 12 months, then 10% flat plus applicable surcharge and cess. Over here also, up to 1 lakh rupees, there is no taxation in a financial year. Important to understand unlisted space also, because this space has seen a lot of supply and demand over the last couple of years. So an unlisted share of a domestic company, the period is less than 24 months for short-term capital gain. The rate is as per the tax slab plus surcharge as applicable plus cess. Anything sold after 24 months will get a taxation of 20% with indexation. So that is a major difference, plus surcharge and cess. Over here, you don't have that 1 lakh rupees exemption in a year. It is only for listed equity and listed equity mutual fund investing in listed shares.
Niranjan, if you don't mind,
Sure.
if you could explain what is indexation for everybody's advantage, please.
Yes, I think so, Kirtan. It is there. I have added two slides on how indexation work, and because that's the most important part. For most asset class, you get indexation benefit. So we have that installed.
Sure.
Coming to debt mutual funds, now here there have been some changes, very, very important changes. So how do you define a debt-oriented mutual fund? So, the recent amendments in taxation, which came in April, defines a debt-oriented mutual fund as any mutual fund which has less than 35% investment in domestic shares, domestic equity shares. Now, with this regulation, all your debt funds, some of the conservative hybrid funds, which has equity capped at 25%, your FOFs investing in foreign ETFs or foreign funds, they also come into this purview, and also gold funds. FOF and gold ETFs, they all come under this at the moment. Maybe some clarification may come, but at the moment all these funds are known as specified mutual fund. Any gain is considered as a short-term capital gain. The taxation is as per your tax slab plus surcharge plus cess. For domestic company, again, the max rate which they pay is 25%, and hence we have mentioned 25% max, but it is again as per their tax slab.
So basically, any fund which does not have 35% and upwards of domestic equity will all be charged at their slab rates.
Absolutely.
Got you.
Again, very important, TDS and tax on mutual fund dividends, which are now known as IDCW, income distribution cum withdrawal plans. For residents, it is taxed. So any dividend IDCW declared by a mutual fund, tax as per the slab rate, surcharge plus cess. TDS on that will be 10% if such income from IDCW is or exceeds 5,000 in a financial year. For non-residents, it is 20% plus surcharge, and TDS is also 20%. Domestic companies tax as per the slab rate, and TDS is 10%. Again, same if the dividend or the IDCW declared is more than 5,000 in a financial year. And hence, we talk about SWP being much better than IDCW. Maybe that is a topic for some other discussion, but these are some important recent developments in last 2 years which people should not.
Niranjan, just a clarification.
Yes.
When we are saying in dividends for a domestic company, they'll be taxed at slab rates. We are saying they'll not be charged more than 25, right? Because I think
absolutely. Yes.
So maximum will be 25, will not be above that.
Yes, absolutely. So whenever it is slab rate, it is as per that.
And also in the last slide, if you could move back.
Sure.
Right. I was just contemplating. So if we do, if let's say as an individual, I am in the highest tax slab, let's say 30, 40, whatever that is, right?
Right.
Doing investments through my company is much better and tax efficient, because the maximum my company will pay as a tax is 25, but as individuals, I might pay 30, 40, whatever that higher number is.
Absolutely. Okay. So corporates, we all know, individuals with surcharge and all, the highest tax rate goes upwards of 40% and all. But for a domestic company, it is much lower on a relative basis.
Perfect. Got you. Thank you.
So, capital gains on bonds now we'll discuss. Now here you will see listed bonds and unlisted bonds. The taxation is same for short term, but what is important to note is the holding period for which they have to qualify whether short term or long term capital gain. For listed bonds, the holding period is 12 months to qualify for long term capital gains, and anything below 12 months or up to 12 months will be short term capital gains. The rate for listed bonds, if you sell it before 12 months, it is as per your tax slab plus surcharge and cess. And long-term capital gain tax, if you sell it after 12 months, will be 10% flat without indexation plus applicable surcharge and cess. Now, coming to unlisted bonds, the holding period to qualify for long-term is 36 months. Anything which is less than 36 months, tax as per your slab rates plus surcharge and cess. And long-term capital gain tax, if you sell it after 36 months, you get 20% with indexation benefit plus cess and surcharge. What is important to note is interest income which you get from bonds are taxed as per slab rates plus cess and surcharge. So if you're holding the bond till maturity, you don't sell it. So all your coupons which you get every year will be added to your income. And they are actually income from other sources, like you get interest from bank FD and it is added to other sources. Clear, Kirtan, anything?
I have just correct me if I've understood this well. If I'm buying a bond and holding it till maturity, right? Whether it is listed or unlisted, it does not matter. Whatever income I've received is going to be taxed at my slab rate.
Absolutely.
Right? Now, only if I
sell.
If I sell it before the maturity,
Yes.
right? Then there is an equation, right? Where we are saying if it is listed, right? Below 12 months is short term and above 12 months is long term. And if it is unlisted, below 36 months is short term and above 36 months is long term, correct?
Yeah. That's
Perfect.
correct.
Got you.
That's correct.
Got you. Got you. And could you also, if at all this falls under the purview of what you are trying to help us understand, what is the difference between listed and unlisted? Are we saying, is this listed on a stock exchange and not listed on a stock exchange?
Yeah, that's correct.
Okay. Okay. Perfect.
Now, the favorite asset class of all Indians, gold. So there are three ways usually, you can invest in gold. One is physical gold, and the other two forms are paper gold, gold ETF and fund of funds, and sovereign gold bonds. Now, let's understand physical gold. Very simple. The period to qualify for long-term capital gain tax is 36 months.
Yeah.
If you sell it after 36 months, you get 20% with indexation benefit plus cess and surcharge. And if you sell it before 36 months, it will attract short-term capital gain tax, which will be as per your tax slab.
Yeah.
Gold ETF and FOF, we just discussed, there is a change in taxation. Anything you sell, at any given point in time will be treated as short-term capital gains. The tax will be as per your tax slab. Sovereign gold bond, again, the holding period is 36 months. If you sell it after 36 months, you qualify for long-term capital gain tax, 20% with indexation. And if you sell it before 36 months, it is as per your tax slab. Important to note is in SGB, if you hold it till maturity, there is no capital gain tax. And the 2.5% interest income which you get in SGB will be taxed as per your tax slab. SGBs are listed, so there's a 5-year lock-in period. So you can't sell it, but after 5 years you can sell it back. But they are listed on exchange. So if you're selling it on the exchange within 3 years and after 3 years, these are a taxation which will be attractive.
Perfect. Niranjan, I'm not sure if this qualifies as an advice or not, but I'm very keen to ask you this question.
Yeah.
After the change in the tax laws, right? It is unparalleled that the sovereign gold bond is a far superior option, right?
Absolutely.
Has the interest in gold ETFs and FOF gone down? Do you see that happening?
So broadly, we thought there will be, the interest will be lost after the changes in taxation. So we run a, gold and silver fund, FOF, which we recently launched. People are investing in it.
Sure.
So, people who are comfortable, they are investing. Also, there are talks that, there may be some clarification on this part because, there is no parity between a physical gold taxation and gold ETF and FOF. So we can expect that, there could be some clarification. Maybe people, hence they are continuing to invest their SIPs and all in that. But honestly, while I represent mutual fund company, not an advice, but SGB is definitely far superior. I keep convincing my wife to invest in SGBs, but they always love physical gold. So the love for physical gold doesn't shine away. So that's how. Yes.
The day you are able to convince your wife, tell me how have you done it, because I
absolutely. I'll do another video on that. Yeah.
Thanks, Niranjan.
Again, house property, favorite asset class for most Indians, though very costly in Mumbai, but people still invest. And so again, the holding period for house property, and house property is not very, very simple in terms of taxation. There are a lot of exemptions. So this is, what we are covering here is maybe just a tip of the iceberg. So it is advisable that you consult with a tax consultant before you do all those things, because there is an entire chapter on, house property and, how it is. So broadly, but some important points to note. If you're holding your house property less than 24 months and selling it, then you will be taxed as per your tax slab. Hefty tax. After 24 months, you get 20% with indexation benefit. Some exemptions that is allowed, if you purchase a new property within 2 years after selling your house, then the gains are not taxed. But over there also you have to invest the entire money along with your own capital which you had invested.
Yeah.
You can also construct a house over 3-year period, then you get an exemption. Till the time you are not investing in new property, if you invest in certain instruments, you are exempted from tax on that amount till 2 years. So a lot of things are there. So broadly 24 months is the period to qualify for long-term capital gains tax, and you get 20% with indexation. But do remember about various exemption and study it well. Now, capital gain tax on other capital assets, because we saw these are specific regulation or taxation.
I think there was one more comment on investing in bonds under 54 EC.
Yes. So various taxation exemption under 54 EC and 54B, which I mentioned. If you are investing that corpus
in a bond,
in a bond till you buy another house within 2-year period, you're exempted from that capital gain tax up till certain period. But ultimately you will have to reinvest that. Only then it is exempted.
So 54 EC are these Power Finance Corporation REC bonds, right?
Yes. I don't know. I don't recollect whether they still are being issued or not.
Yeah, they are issued, and typically the way this is happening is if I have let's say 20 lakhs of capital gains, I can invest that money in these 54 EC bonds, which are locked in for some 5 years, and they pay 4.5% interest something, and then I don't have to pay tax on it.
Yes.
Correct.
And else in between you can also deposit in maybe PSU accounts, bank accounts, certain with certain conditions, and then
I think for 6 months, if I'm not wrong, they allow you, and then after 6 months you have to buy up. Like you rightly said, there's too much of complications here.
Yes. There can be entire video on this.
Absolutely.
How to manage your house property tax, and also on the salary part, when you take a loan, whether you claim HRA, not claim HRA, a lot of things.
Correct.
Coming to the final part of this, like on the taxation, we have covered specific capital assets where the taxation are different or the holding period is different. But for all other asset class, where again 2-3 things come in, which is other mutual funds now, which falls between the specified mutual fund and equity mutual fund. So there will be certain mutual funds which will have equity exposure between 35 to 65%. What will be the taxation for that? People have this question. So my understanding is basically it will be falling under the other capital asset taxation, which is if the holding period is more than 36 months, you get 20% indexation with cess and surcharge, and if you sell it before 36 months, it will be taxed as per your tax slab. So broadly, these are the capital gain tax for various. Yes, Kirtan.
So Niranjan, just to clarify, so we are saying there are 3 product categories that we are talking about here broadly. So if you have less than 35% in domestic equity, right, you're going to be taxed like a fixed deposit.
Yes, fully taxed, no short-term or long-term, everything is taxed as short-term.
If you have above 65% in domestic equity, you will be taxed as per equity.
Yes,
right?
absolutely.
10% for more than 1 year and 15% for less than 1 year.
Yes.
Right. And the third category is between this. Either has, so it has equity component anywhere between 35 to 65% this is how they are going to get taxed on the slide that we see, right?
Yes, this is because then it falls, because then it's a no man's land. Correct. So it falls under other capital assets.
Got you.
and then this taxation gets attracted to that.
Perfect, 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 perfect.
So just to summarize, some important asset class, uh, equities, qualification for long-term capital gain about 12 months, tax short-term 15%, long-term 10%, unlisted equity, qualification for LTCG 24 months, STCG tax slab, LTCG 20% after indexation,
Wow.
debt funds, now everything is short-term
Correct,
as per tax slab,
correct.
physical gold 36 months, short term is tax at
That's
tax
right.
slab, and long term is 20%. House property 24 months,
Sure.
20% after indexation and marginal rate. Listed bonds again, and then 12 months we saw, and all other capital assets, which will include that third category of mutual funds, gold, offshore funds. No, sorry, this will be other than equity and debt
Other
funds,
than
will be
equity
as
and
per tax slab,
yeah,
and 20% after indexation.
perfect. This is a very brilliant slide. I think you've summarized everything that you spoke of in the last 25-30 minutes brilliantly in this one slide.
Yeah, thanks. Now I think so we'll just understand basics thing, how to calculate short-term capital gains. You start with full consideration which you've got. If you have any expenditure in connection of such transfer, be it taxes, STT and all, you can deduct it. Cost of acquisition, in case of house property, cost of improvement is also allowed in certain capital assets, and that is your short-term capital gain. Long term is also
Can you
same.
quickly give
Yes.
some numeric examples, some random numbers?
Yeah. So say for example, you invested 1 lakh, you exited at 1.5 lakh,
Correct.
and let's take an equity fund.
Yeah.
Within 12 months you got 0.5 lakh 50,000 as a gain. If it's a mutual fund, everything is after expense and all, STT
Yeah.
and all.
Yes.
50,000 is your gain. On that you pay short-term capital gain tax, which will be 15%.
15%. Perfect. So you pay 15,000 rupees plus surcharge plus sales tax.
Yes, absolutely.
Yeah.
Absolutely.
Perfect. Perfect.
Now, on long-term capital gain, same process. The major difference here is in certain asset classes, which we just saw, you get indexation benefit. So instead of deducting the cost of acquisition, you deduct the indexed cost of acquisition, and we'll see what it is and how it is calculated.
Sure.
And then you get the amount, and then you pay the long-term capital gain tax. But here, most important part is calculating the indexed cost of acquisition. And then hence we will understand what is indexed cost and what is indexation. So first, what is indexation? So indexation broadly in simple terms is government allows you to, take benefit of inflation, eating away your returns. So in very crude example, if you earn a 10% return for a year, and in that period, 6% is inflation, your net gain after inflation is actually 4%. So government is saying certain asset class, okay, pay tax only on that 4%. I'm not going to eat into your gains which have gone away because of inflation.
Perfect.
So for that, what government does is it calculates a cost inflation index every year, and it is usually 75% of CPI of urban index, urban population, and that becomes the cost inflation index for the year. And so it keeps increasing so when periods of high inflation, we have seen it going up by 5, 6, 7, 8, 9%. When inflation broadly in the economy is lower, it has gone down. So in last 1 or 2 recent years, it has been higher. For last 23 years, the average cost inflation index has been around 5.5%.
Oh, nice.
I think so with an example, we will maybe understand this better. If you see, indexation is an efficient way to reduce your tax on your returns by adjusting it for inflation. Indexation allows you to adjust the purchase price of your investment with inflation. So in nutshell, higher inflation means your higher purchase price. higher indexing to inflation, which means lower tax.
Yeah.
So let's understand this with an example. So if you have purchased, let's take an unlisted stock, because there you get an indexation benefit. After 2 years, you sell it, after say 3 years, you sell it for 330 rupees.
Mm.
Now, cost inflation index, when you purchased this, maybe 3 years back, was 110.
Mm.
And this year, in the year when you have sold, the government comes up with CII after the year end, it is 130. So the inflation has gone up from 110 to 130. Your price has gone from 240 to 330. Now, your cost of acquisition was 240, but you have to index it, adjust it for inflation. So you index it, you adjust it. So, you adjust your purchase price, multiply it with the exit CII rate and divide it by 110. You get the indexed cost, which is 284. So instead of 240, if you add inflation, your actual cost of acquisition becomes 284 rupees. Now, if you reduce this, the exit price with this, your gains after indexation is 46 rupees, which is 330 minus 284, 46 rupees. Tax payable on 46 rupees, 20%. I've not taken surcharge and cess for simplicity. That will be added, but you pay 9 rupees as tax. So net gain after tax for you is 81, which is 330 minus tax which you paid, 81 rupees. Now post-tax gain is on an absolute basis is 34%. Pre-tax gain was 38%. Now assume you don't have indexation benefit. So I've not added that example. I should have added that. You will end up paying on 90 rupees. Maybe say if you are in 30% tax bracket, you will end up paying almost 30% of 90, which is roughly around 27, 28 rupees. Here you have paid only 9 rupees as tax.
Right.
So that gives you, and effectively your tax has come down drastically. So you've roughly paid only 10% tax on your actual gain.
In fact, now that you are saying this, I'm just reflecting back. So on all of these assets where you have indexation advantage, you are actually paying less tax than even equities.
Absolutely.
Because if you are saying in the last 23 years, the index has grown at 5.5%, let's say a debt product is generating 7%, or let's say 8%. On 8%, you reduce that 5.5, which is inflation, very crude, right?
Yeah.
So you are left with only 2.5. On that 2.5, you pay 20% tax, which is 0.5.
Yes.
So 8 minus 0.5, you are actually making 7.5 in hand, which is much lower than 10% tax that you paid out.
Absolutely.
So I think it is more theoretical in nature that people feel that on the fixed income side and on the gold side and all, there is taxed at 30% and my slab rates. But because of indexation, your tax net outflow is much lower than even equity.
Absolutely.
Yeah.
So if your returns are, back of the envelope calculation, if inflation index is around 5-6% and your returns are in 10% bracket, you are much better off with indexation benefit.
Yeah.
It only hits you if the returns are 15, 16, 20%, but over a longer period of time, that's not the case.
Correct. Absolutely. Interesting.
Certain important point, you can set off and also carry forward your capital loss. So income tax does not allow loss under head of capital gains to be set off against any other heads. So whatever losses and all are there, you can set off within capital gains. So you can have equity and set it off against debt, mutual fund, all that. So the rule is long-term capital loss can be set off only against long-term capital gains, but short-term capital losses are allowed to be set off against both long-term as well as short-term gains. In terms of carry forward, short-term and long-term capital loss can be carried forward for 8 assessment years. From the year in which you have that loss, you can carry forward for 8 next financial years, assessment years.
So Niranjan, just correct me if I've understood this well. We are saying rule one, if I've had a long-term capital loss, so let's say I invested in a stock at 100 and I, after 3 years, exited at, let's say 80. So I've got 20 rupees of loss.
Yeah.
So I can carry forward that 20 rupees of loss in my books for 8 years.
8 years,
And
yes.
within 8 years, whenever I make long-term capital
gains, you can set it
on
up.
Another stock, let's say I bought at 100 and sold it at 120, there is 20 rupees of gains. Then I pay no tax because minus 20 plus 20 squares off.
Absolutely.
Correct? Okay.
Correct.
Okay. So long-term can only be set off against long-term. That is rule one.
Right.
Short-term losses are allowed to be set off against long-term and short-term gains both.
Both.
Perfect.
Yes.
Got you. Got you. Thank you.
So broadly, certain important exemptions in capital gains. If you are 60 years below, 2.5 lakhs, which is our normal tax slab. If your overall gains are not till 2.5 lakhs, you are not charged capital gains till 2.5 lakhs. So if you have zero gains and your gains are only from capital gains up to 2.5 lakhs, no tax. After that, of course, you will be taxed.
So if I have no income and capital gains up to 2.5 lakhs, I'll not be taxed.
Yes, yes.
Okay.
Again, 60 years and above, 3 lakhs, 80 plus 5 lakhs. These are the same exemptions on income tax. Same applies here. HUF with an annual income of 2.5. No capital gain applies for sale of agriculture, rural land we have seen. And, if individual uses the entire sales proceed in house property, we saw within 24 months, if it, reinvested, they are not taxed. So these are certain exemptions which we have covered earlier also, but just to summarize. Yes, and lastly, again, the disclaimer that, it is only meant for general information. I am not tax expert. I'm not a legal tax advisor. So these are basis current financial year, which is FY 2024. And do take tax opinion, do speak to your, consultant if you are planning any tax harvesting or any specific taxation on this. With that, thank you, Kirtan. And if you have any other questions or any discussion point which we have left to discuss, or if you want to add anything, you can, sure.
I think Niranjan very interestingly, very simply put across, because tax otherwise is such a complicated subject, right? Even while people like us who are completely involved in this, it happens with me that a lot of time I have to Google when somebody randomly asks me, and I'm like, "Arey, ruk ja, 1 minute dekhe nahi de, I don't know."
No, it is always that. In fact, when you told me on tax pay karna hai, it was a great refresher for me. I remember my, cost accounting exam days where within one day we had to read and learn all sections, not only from direct tax, but also indirect tax. Abhi to GST aa gaya, isliye simple ho gaya. But then, I still remember I read in that one night, and so 24 hours, I slept only 3-4 hours, and I read that entire 800 book tax guide before the exam. So I completely agree with it. It's very confusing.
Crazy. But let me tell you, you've quite simplified a lot of these things that were all over the place. And also because it's in a video format, anybody can just come back to this video and revisit whatever they really want to understand, if they are going through something where they need to understand these tax nitty-gritties. Niranjan, thank you so much. You've been a great orator. For everybody who's been watching us, thank you so much. I hope you've subscribed to the channel. Click the bell icon so that you receive a notification every time we upload a video. And we will have Niranjan come back to us again on some topic, again, because I know he can speak on multiple topics. And I wanted to do on tax, and I pushed him to do on tax, but he's great at various other topics ranging from fixed income and various other things. So I will try my level best to have Niranjan again. But Niranjan, thank you so much for taking the time out. And
thank you so much, Kirtan, and wish you all the best with this new series. I think so it covers, I think so each of these series with many industry folks would be a good masterclass. and you yourself are expert in so many topics. So, I would see you also covering a lot of these topics. We learn a lot from you. So glad to be here. Thank you so much.
So learning is very mutual, and I hope to have you on the show again.
Thank you.
Thank you so much.